It's like watching a local car rental agency get infected by a Wall Street algorithm, almost die from the virus, and then, cure itself by becoming an AI software company. Welcome to today's deep dive.
Thanks for having me.
So our mission for you today is an 80-year audit of Onity Mortgage. We're unpacking how a 1946 corporate car fleet manager and a 1988 subprime data miner merged to survive a regulatory apocalypse.
Right, and how they emerged as this 2026 AI-driven financial powerhouse. To track how those two wildly different DNA strands combined, we actually have to start in the physical world.
Post-WWII America, right? Like
Yeah.
1946.
Exactly. There's this massive vehicle shortage, but corporate sales forces are expanding rapidly. So three partners form Peterson, Howell, and Heather, or PHH.
And they solve this crunch with the finance lease. It's essentially the original corporate car subscription service.
Yeah, taking the heavy capital burden of owning vehicles completely off the business's balance sheets. And once you're managing the fleet, well, you're tracking the sales reps driving them. That data makes handling corporate relocations the logical next step to capture more margin. So they buy home equity in 1971 to physically move the employees.
So if they're already appraising these homes and coordinating the moves, the obvious leap from there is to just finance the houses themselves.
Which they do. They enter the mortgage business in 1984, building a squeaky clean reputation as a trusted outsourcer. But while PHH was building that pristine brand, a completely different entity was launching in Florida in 1988.
Ocwen Financial.
Yeah. And they went aggressively into the emerging subprime mortgage market. Instead of treating loans like traditional relationship banking, they treated them as a massive behavioral data problem.
Right. They dumped over $150 million into a proprietary tech platform called Real Servicing.
Oh.
But I have to challenge the logic here.
Oh, absolutely.
Because we know this system spectacularly failed between 2013 and 2017. Like, regulators found robo-signing, unauthorized fees, and issued a $2 billion penalty.
Yeah, it was bad.
Wait, so how does a company spend $150 million on software and miss basic arithmetic, like causing 10,000 borrowers to lose their homeowner's insurance over escrow errors? Were they just ignoring the bugs?
Well, the predictive algorithms actively broke the accounting side. Their code prioritized predictive default modeling over fundamental ledger principles.
Like properly routing property tax or insurance payment.
Exactly. I mean, ambitious data mining without operational compliance is a ticking time bomb. They engineered a system to squeeze out profits from distressed borrowers.
Wow.
But it fundamentally couldn't perform basic middle school math for an escrow account.
Wow.
And fixing it would have cost $1.5 billion, which Ocwen simply didn't have.
So drowning in toxic tech debt, Ocwen had to buy a lifeline. In 2018, they somehow managed to acquire the squeaky clean PHH for $360 million.
It was basically a strategic transfusion. Ocwen wasn't buying volume. They were buying PHH's pristine institutional reputation and a completely new leadership team under CEO Glenn Messina. Messina recognized the proprietary tech was killing them, so he migrated over 1 million loans off Real Servicing onto an industry-standard platform.
If you're operating in a data-heavy industry today, Onity is the ultimate cautionary tale. Sometimes the only way to survive is to ruthlessly kill your own proprietary tech before it kills you.
100%. They eventually scrubbed both legacy names entirely, rebranding in 2026 as Onity, which symbolizes being on it.
And with the new brand came a shift to capital-light subservicing. Let's unpack that term for a second for you guys listening.
Sure.
Capital-light subservicing essentially means they don't own the risky loans anymore, right? They just do the customer service and back-end paperwork for the institutional banks that actually own the risk.
That's the core of it, yeah. They abandoned the hostile debt collector approach and became a collaborative partner. They rolled out an AI assistant called LASI.
LoanSpan AI.
Right, giving clients total transparency. This predictive modeling was so effective, it practically doubled their refinance recapture rates.
Meaning, when a homeowner decided to refinance, Onity's AI was so proactive that they kept the customer's new loan rather than losing them to a competitor.
Exactly.
They basically went from being the aggressive club bouncer to a hyper-efficient hotel concierge. It's an incredible 80-year turnaround from managing cars to managing digital portfolios.
It really is. But, they still face hurdles. Going into 2026, Onity is losing a massive $32 billion contract with their largest client, Rhythm.
Ouch.
Yeah, though Onity is framing that loss strategically. They're using the contract expiration to simplify their balance sheet and permanently purge deeply delinquent portfolios from their system.
Which really is the ultimate test of their streamlined new identity.
Yeah.
So considering this wild evolution, I want to leave you with a final thought to mull over.
Let's hear it.
If AI and predictive modeling can successfully rehabilitate the legally toxic subprime servicer into a trusted, automated financial partner, well, what happens when this exact same AI technology bypasses institutions entirely and starts directly negotiating debt and real estate decisions on behalf of everyday homeowners?